Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's our privilege today to host Martin J. Gruenberg, the chair of the Federal Deposit Insurance Corporation Board of Directors. We're going to have a discussion today from Marty Gruenberg's remarks on how strong, high-quality capital is essential to fostering resilience in the banking sector, and this is one aspect of this that is key is international coordination and regulation, and in particular, the agreement to and implementation of what's called Basel III. Finalizing Basel III standards in the U.S. continues to be a top priority for the FDIC and the other federal banking regulators and agencies. I think it's important to recognize that while there have been a series of events in recent months that have put the FDIC squarely on the crisis line, the ongoing work of the FDIC and its colleagues on systemic stability and resilience continues. And we're not making light or by any way commenting directly on what the crisis response was, but just to say that if you don't want to have more crises, you should be trying to do work on an ongoing basis. And I give the FDIC credit for not losing sight of that. Martin Gruenberg was sworn in as chair of the FDIC Board of Directors January of this year. He's been a member of the board since August 2005 and previously served as vice chair from August 2005 to July 2011, and previously as chair from November 2012 to mid-2018. We were fortunate to have Marty speak at the Institute a couple times during his service, and he's obviously been a thoughtful interlocutor, and by those dates tells you a very dedicated public servant for this time. Marty joined the FDIC board after broad congressional experience in financial services and regulation. He was senior counsel to Senator Paul Sarbanes on the staff of the Senate Committee on Banking, Housing, and Urban Affairs from 1993 to 2005. He also served as the staff director of the Banking Committee Subcommittee on International Finance and Monetary Policy from 1987 to 92. Internationally, he served as chair of the Executive Council and president of the International Association of Deposit Insurers from 2007 to 2012. And he has, since 2019, served as chair of the board of directors of the Neighborhood Reinvestment Corporation, also known as NeighborWorks America. He is now, since February of last year, chair of the Resolution Steering Group of the Financial Stability Board, which is, of course, a G20 related organization. So with that, we're privileged to have a public servant and an international regulator, but most of all, the chair of the US FDIC, Martin Gruenberg. Please.
Adam, thank you for that very kind introduction. I really appreciate it. It's a pleasure for me to be here this morning. And I'd like to begin by thanking the Peterson Institute and Adam for inviting me to speak with you all today. The topic I'd like to discuss, as you all know, is the Basel III capital framework. Strong, high-quality capital is essential to fostering resilience in the banking system through economic cycles and periods of economic stress. Finalizing the Basel III capital standards in the United States in a timely way continues to be a top priority for the FDIC and the other federal banking regulators. This morning, I'd like to share some thoughts on why finalizing Basel III is critical for the safety and soundness of the U.S. banking system, for financial stability, and for the performance of the U.S. economy. So to begin with, this has been a project long in the making, and let me give you some of the background and context for this. As we entered the global financial crisis back in 2008, it was clear that neither banks nor regulators understood the magnitude of the financial stability risks that had developed in prior years. We also did not appreciate the vulnerability of our nation's largest, most systemically important financial institutions, which were found to be woefully undercapitalized and over-leveraged. In response to the global financial crisis, the U.S. banking agencies set out to strengthen the banking system through major revisions to the capital framework. These revisions were consistent with a set of standards issued by the Basel Committee on Banking Supervision in 2010, that's known as Basel III. Through the initial implementation of Basel III, the agencies increased the overall quality and quantity of risk-based capital. They also complemented this risk-based framework with an enhanced supplementary leverage ratio requirement for the largest banks, added regulatory capital buffers that incentivize banks to build capital levels, and introduced new quantitative liquidity requirements. That was the first phase of Basel III. In 2017, the Basel Committee issued a second set of revisions that are intended to bring these Basel III reforms to a close. In the United States, we already have strong leverage capital ratio requirements. However, there are areas where we can improve the risk-based capital regime to address weaknesses identified during the 2008 financial crisis. The stated objective of these revisions to Basel III is to reduce excessive variability of risk-weighted assets and address certain weaknesses identified during the global financial crisis. These reforms address the calculation of risk-weighted assets and limit the extent to which banks can use internal models to estimate risk to calculate minimum capital requirements. Now, there are 4 critical areas of risk under this final phase of Basel III: credit risk, market risk, operational risk, and risk associated with financial derivatives, all key risks identified as vulnerabilities during the 2008 crisis. And so let me describe briefly how Basel III addresses each of these key risks. With respect to credit risk, Basel III introduced a new standardized approach that also serves as part of a so-called output floor on modeled risk-weighted assets. The Basel III reforms are intended to increase the granularity and robustness of the credit risk capital framework while addressing flaws associated with internal models. While the international standard does constrain somewhat internally modeled approaches for credit risk, the FDIC has long had concerns about the use of internal models in establishing minimum capital requirements for credit risk. Basel III offers an opportunity to introduce a standardized approach for credit risk in lieu of the model-based approach to enhance transparency and comparability of the risk-based capital framework. This is an issue I'll come back later as well. So second, in regard to market risk, and let me just warn you, this is a particularly complicated area. With respect to market risk, during the global financial crisis, banks incurred significant losses in their trading books. That is, their portfolios of instruments traded over the short term, exposing weaknesses of the existing market risk capital framework. For example, credit markets, in particular those related to structured products like collateralized debt obligations, or CDOs, collapsed during the 2008 crisis. This severely impacted liquidity in those markets. Banks were able to use so-called internal value at risk models for these positions, even though the models inadequately captured the risks. More specifically, the models were calibrated to a 10-day loss horizon, even though there was no adequate market liquidity to justify such a horizon. Furthermore, many of the value at risk models used proxy risk factors from other more widely traded products as approximations. These heavy use of proxies on less liquid trading positions materially underestimated the risk in these products, particularly the CDOs, and contributed to the undercapitalization of many banking organizations during the global financial crisis. Now, to deal with the most pressing deficiencies in the market risk capital framework, the Basel Committee introduced a limited set of revisions back in July of 2009, and then set out to address a number of other issues to improve the overall design and coherence of the capital standard for market risk. And this led to the so-called fundamental review of the trading book as part of this final round of Basel III. The fundamental review of the trading book represents a notable improvement to the existing market risk framework. It employs a more robust methodology to capitalize for potential tail risks, using the so-called expected shortfall methodology, as well as market liquidity risk under stressed conditions. It also sets out more stringent requirements for the use of internal models for calculating capital requirements, and in addition, it introduces a new standardized measurement for market risk that provides a more consistent approach to calculating capital requirements. So now let me turn to operational risk. The Basel III reforms associated with operational risk also represent improvements over existing standards. Operational risk refers to the risk of loss resulting from inadequate or failed internal processes, from people and systems, or from external events. Importantly, as the size and complexity of a financial institution increases, there are more opportunities for operational risks to manifest, including through gaps or other deficiencies in internal controls that result in operational losses. Operational risk exposures have been and continue to be a persistent and growing risk for financial institutions. For example, large financial institutions faced stiff settlement costs associated with their mortgage activities leading up to the 2008 financial crisis, while in recent years, ransomware attacks, as well as other cybersecurity risks, have increased significantly. The operational risk framework in the United States is currently based on the Advanced Measurement Approach Framework, which requires banks to develop internal models for operational risk. However, modeling operational risk has proven to be problematic. Internal model estimates can present substantial uncertainty and experience volatility resulting from new data, introducing meaningful challenges to capital planning. Reliance on internal models has resulted in a lack of transparency and comparability as well. The revised Basel III framework moves away from internal models for operational risk, replacing the model-based approach with a standardized approach that is adjusted for banks' own historical loss experience. So finally, during the global financial crisis, banks incurred significant losses associated with derivative activities, as my guess is most of you know. A derivative transaction's performance is subject not only to the performance of the underlying assets, but also to the credit risk of the counterparty. The initial phase of Basel III introduced a capital requirement for potential changes in the value of derivative instruments as a result of the deterioration in the credit worthiness of a counterparty. This so-called credit valuation adjustment, or CVA, was a major source of losses for banks with derivative trading operations during the global financial crisis. The Basel III reforms would improve estimation of CVA risk by introducing new frameworks that would be consistent with the more robust methodology under the revised market risk framework. So look, this is pretty complicated stuff, as I guess you've noted already, but in a nutshell, these are the core components of this Basel III Endgame. So let me make a few remaining points regarding our path forward here on Basel III. In the near term, the FDIC, together with the Federal Reserve and the Office of the Comptroller of the Currency, will issue a notice of proposed rulemaking to seek public comment on changes to the U.S. capital framework to consider how best to incorporate the finalization of Basel III. A key consideration with respect to these revisions is the scope of application. In other words, which banks will be subject to the proposed rule. For example, the agencies are considering whether to apply the proposed new rule to banks with assets over $100 billion. This consideration, candidly, has been influenced by the recent experience with 3 bank failures of institutions with assets between $100 billion and $250 billion. If we had any doubt that the failure of banks in this size category can have financial stability consequences, that has been answered by recent experience. In this regard, it is worth noting that although Silicon Valley Bank's failure was caused by a liquidity run, the loss of market confidence that precipitated the run was prompted by the sale of assets at a substantial loss that raised questions about the capital adequacy of the bank. Had the unrealized losses on available for sale securities on the balance sheet of SVB that were realized once sold, had they been required to be recognized in capital, as the Basel framework would do, but is not currently the case, it might have averted the loss of market confidence and perhaps the liquidity run. That is because there simply would have been more capital held against those assets. The broader lesson to take away here is that banks in this size category can pose genuine financial stability risks, and the federal banking agencies need to review carefully the supervision of these institutions, particularly for interest rate risk in the current environment, and the prudential requirements that apply to them, including capital, liquidity, and loss-absorbing resources for resolution. Community banks, which are subject to different capital requirements, would not be impacted by the proposal given their limited overall size and trading activities. Now, With regard to the impact on bank capital, this phase of Basel III is expected to increase risk-based capital relative to the risks I just discussed. These were serious risks identified during the 2008 global financial crisis that were significantly undercapitalized. And this phase of Basel III seeks to address those risks. The implementation of the Basel III reforms would strengthen our banking system while also improving the efficiency and availability of credit through varying economic conditions. In fact, banks that were most impacted by recent capital and liquidity reforms may see a reduction in their cost of both debt and equity. The estimated capital impact on banking organizations will be described in the notice of proposed rulemaking that will be acted on by the federal banking agencies in the near future, and of course will be subject to an extensive public comment period. Now, concern has also been raised that an increase in capital requirements now could be a drag on bank lending and the US economy. There are a couple of points to be made in this regard. As I indicated, the federal banking agencies will shortly act on a notice of proposed rulemaking. A final rule is not likely to be acted on before the middle of next year. Once a final rule is acted on, the implementation, once the rule takes effect, would be several more years. So, in other words, the impact of the rule on the banking system is not likely to be felt for several years, and that impact would be phased in gradually. And in addition, and to be clear, stronger capital improves the resilience of our largest banks and enhances their ability to lend through the economic cycle. History has proven that insufficient capital can lead to harmful economic results when banks are unable to provide financial services to households and businesses, as occurred during the 2008 financial crisis. Ensuring adequate amounts of bank capital provides a long-term benefit to the economy by enabling banks to play a counter-cyclical role during an economic downturn rather than a pro-cyclical one, which is frankly what occurred in 2008. A key component of the capital framework is the risk-based requirement, which is meant to increase commensurate to any increase in risk that a bank assumes through lending or capital market activities. Implementing a more risk-sensitive requirement will serve to ensure that banks shoulder the risk of their own operations, preventing the buildup of excessive systemic risk. Further, equity capital is not locked away in a manner that inhibits its use to support the real economy. Rather, it is deployed in numerous ways that benefit the bank, its stakeholders, and the economy. Equity capital funds a bank's operations, is allocated to make loans to local communities, and can be distributed to shareholders when appropriate with sound financial performance. So let me take a moment, if I may, also to talk about some of the lessons we learned from the pandemic that may be relevant to this discussion. Since the pandemic, some have argued that the strong performance of the large banks during the pandemic demonstrates that they had adequate capital to withstand a stress environment and that no additional capital requirements are needed. There are a few points to make here. First, it's true that the first round of Basel III reforms, strengthening the quantity and quality of capital for our largest banks, served the economy well during the pandemic, reinforcing the strong role capital plays through economic cycles. Large banks were clearly much more resilient entering the spring of 2020 as a result of Basel III. However, it would be a mistake to consider the pandemic a true stress test of the capital adequacy of the banking system. COVID-19 was an exogenous event that necessitated a swift and forceful public sector response. In total, the federal government's support is estimated to have been well in excess of $10 trillion. That response helped to bolster the financial health of bank customers, as well as the markets within which banks operate. These actions insulated banks from runs and losses, while some measures served to boost bottom line profits with minimal risk to capital. This should be the context through which we consider overall capital adequacy and the improvements to risk-based capital that are provided by the Basel III revisions. Finally, it has been suggested that since Basel III will raise risk-based capital requirements, leverage capital requirements should be lowered to offset the burden on the largest banks. Maintaining a strong leverage capital requirement. As improvements are made to the risk-based capital framework is an important principle to ensure continued resilience in the U.S. banking system. This is because the leverage capital framework, while relatively simple, does not differentiate assets by risk and ensures, though, that banks hold a base of capital proportional to their exposures. As the federal banking agencies indicated when finalizing the enhanced supplementary leverage capital ratio for our largest banks, leverage capital and risk-based capital frameworks are complementary and work together to provide a stronger regulatory capital foundation than either measure would in isolation. Risk-based capital requirements, frankly, can be managed by banks to minimize capital impacts, meaning we can't be confident that increases in the risk-based regime will hold through time. In addition, banks' own models and the regulators may get the risk weights wrong, and that has happened. Leverage capital requirements and the risk-based capital framework are therefore mutually reinforcing in that each cover risk which the other is less able to capture. This ensures that banks do not operate with excessive leverage and at the same time have sufficient incentives to keep risk-taking in check. That is why maintaining strong leverage capital requirements along with risk-based requirements will ensure the resiliency of the largest, most systemically important banks is not compromised. Indeed, maintaining robust leverage requirements is important as we move forward with implementation of the revised Basel III risk-based standards. It was an essential post-crisis reform that must not be weakened. So, in conclusion, a robust regulatory capital framework is the cornerstone of a resilient banking system. Strong levels of capital available to absorb losses ensure that banks have the ability to continue to lend to their customers through business cycles, including during stress. Basel III finalization and implementation is a top priority for the FDIC and all of the federal banking agencies. It offers us the opportunity to make important modifications to the risk-based regulatory capital framework with the ultimate goal of enhancing the financial resilience and stability of the banking system, better enabling it to serve the U.S. economy. That's my story for today. Thank you very much for the opportunity to talk with you.
Thank you. Microphone. Thank you. All right, I'll try to reach the microphone. There we go. Thank you very much, Marty. You are sober and deliberate, and I think we all appreciate your opening with the failings of what the supervisory community and the regulatory community missed heading into 2008. Before we get into the longer term stuff, we have to talk about what may or may not have been missed in recent months. So you listed 4 areas of risk that the Basel III implementation or Part 2 implementation would address. Interest rate risk wasn't enumerated among those. Notwithstanding your point about higher capital being part of it, how do you think about interest rate risk in the Basel III framework? Would it have done anything, had Basel III already been implemented, have done anything to address that?
I think the one, as I mentioned in my remarks, the one provision of Basel III, capital liquidity and interest rate risk sort of go together. I think the one provision of Basel III that would have been highly relevant to the recent events would be the change in the capital treatment of unrealized losses on available for sale securities. Banks accumulated concentrations of securities on their balance sheet because of, in a way to manage what had been the prolonged low interest rate environment, trying to earn returns above that. When the interest rate environment changed and interest rates rose, those securities lost value and accumulated substantial unrealized losses. So that, in effect, is an interest rate risk issue. And right now, those unrealized losses on those available for sale securities do not flow through to the capital requirements of the institution. So in the case of SVB, when they sold a bunch of assets, took a big loss, their capital took a big hit, the market said, whoa, they're worried about the capital, and by the way, they're selling assets to raise liquidity, and you had the events that unfolded. If the unrealized losses had been required to flow through to capital, the bank would have been required to hold more capital against those assets, and that would have meant that the capital hit on the institution would have been easier for the institution to absorb. Perhaps, you never know with certainty about these things, but it would have been more reassuring to the market in the circumstance. Certainly relevant, and I think better capital policy for those unrealized losses to flow through to capital, particularly for these larger institutions.
Thank you for spelling out the logic and the link to Basel III. For those of us who are not quite as into the operational realities you're talking about, when you talk about capital flowing, the losses flowing through to capital, on what kind of time frame does that happen? Because obviously there was this sense that SVB unfolded very quickly.
Well, had it been in place,
yes,
then the bank would have had to have been holding capital against those assets or against those unrealized losses, because there was no requirement.
Right.
There was no additional capital held against them. And I want to be clear that assuming we move forward here, and I also made this point, any change in capital requirements would be phased in over a period of time. so that the institutions would have an extended opportunity to manage the adjustment.
Moving back to the more broad themes you talked about, the argument, as you referenced, against additional capital is usually framed in terms of diminished credit availability over some span of time. In your view, this seems to be a non-issue, and there are a number of regulators and academics who agree with you. But could you say a bit more about the evidence on this point? And also, isn't to some degree reducing credit availability part of the point, that there's a tendency to overlend?
Well, you want to reduce badly underwritten credit, just
Right.
and you want to be sure to capitalize against that.
Right.
So we want to support credit to the economy, but we want to support well underwritten credit that can be sustained over time by the institution. One thing I've learned is that there's no good time either to increase deposit insurance assessments or to raise capital. I've learned that lesson. In good times, that people say you don't need to do it.
Right.
And in bad times, they say do it during good times.
Right.
So that's sort of the logic and the challenge associated with this. There have been quantitative impact studies that have been done that have shown that stronger capital reduces the likelihood of failure, the disruption to the system that goes with it, and also demonstrates or supports the ability of banks to continue to extend credit through the economic cycle. So from a long-run perspective, a strongly capitalized banking system really is consistent with and supportive of access to credit for the economy.
Another development, particularly in recent years, has been the shift of various forms of lending, including, for example, on commercial real estate, to non-bank financial institutions, what some of us used to call shadow banks. A different line of argument against stricter capital and liquidity requirements is that this will further drive activity, lending activity of various sorts outside the regulated supervised banking system to these less regulated shadow banks. What's the evidence in your view since Dodd-Frank and the first round of Basel III on this question? And also, again, just to provoke, I mean, isn't part of the point to get the riskier stuff out of the regulated banking system?
I always have trouble with the logic of saying we shouldn't have appropriate capital standards to strengthen the resilience of the banking system, because then assets might flow out of the banking system. So the logic there seems to be have more vulnerable banks in order to avoid that happening. And that the logic of that, given our experience, is hard for me to understand. I think we need to set appropriate capital standards to the risk of the banking institutions. Non-bank financial institution risk is a big ticket item. It's a big ticket item in the United States. It's a big ticket item globally. It's been is a subject of attention by the Financial Stability Oversight Council here in the United States. It's been a priority of the Financial Stability Board internationally. So it's a key risk area that requires great attention, but it requires great attention on its own terms, and we need to consider means of addressing it. But this should not, in a sense, be a zero-sum game with the banking system. I don't think we want to compromise appropriate capital requirements for the banks, because of that concern.
As you just mentioned, a lot of the issues facing U.S. banking system also face other high-income economy banks, and we're interconnected. Basel III is obviously, by its name, an international agreement. Could you recap a bit why you believe it's worthwhile for U.S. regulators to be cooperating and even agreeing on standards with their international counterparts, rather than, as Congress seems to desire in a lot of other fields, the U.S. sets the rules it wants and lets others just sort of stew about it.
Well, first, let me be clear that these capital standards are U.S. standards that we, the federal banking agencies, are establishing because we think they are appropriate to address the risks in the banking system. That being said, we understand too well that banking markets and financial markets are deeply integrated internationally. So what happens in other jurisdictions is relevant to the United States. So there is enormous value in having some level of consistency and comparability across the major jurisdictions so that the United States and the other major jurisdictions of the world have appropriate capital standards to maintain the stability and resilience of their national systems and ultimately the international system. So the rationale for some engagement and coordination here is compelling, I think. I think the Basel framework is an example of effective international coordination and cooperation in this area. But at the end of the day, these are capital standards established by U.S. agencies because we think they're appropriate to the risks of our banking system.
As president of Peterson Institute for International Economics, I'm obviously very favorably inclined to your answer, but nonetheless, let me push you a little bit on that. The usual notion of international negotiations is different countries, even in good faith, have different interests, different starting points. There's some give and take. Not just in traditional trade negotiations. For example, in insurance, there was a great deal of give and take over what was called Solvency II and was seen as a big push by European insurers. Are you able to say anything about give and take in this Basel III process, or was it just the choir all came together in perfect harmony?
I wouldn't say that. I mean, this agreement, as I mentioned at the outset, has been a long time in the making. These international accords where you're trying to get agreement, across major jurisdictions, as you point out, with different players and different interests, is no small challenge. I think the outcome on Basel III is a genuinely appropriate and strong one that will improve the resiliency of all the countries, of the banking systems of all the countries that are participating in it, and will also provide greater comparability across jurisdictions. And U.S. these are a minimum set of requirements, and certainly the implementation of Basel III in the United States will be very much, a U.S. implementation based on what we believe are the, risks that warrant the capital standards we're going to propose.
Thank you. Just again, another piece on the international aspect. In your various roles as chair of the FDIC, but on these international bodies and conferences and so on, you know better than anyone that there are very substantial differences in deposit insurance frameworks across countries. Different levels of protection, different who gets protected, different degrees of flexibility in the event of runs or crises. What to you are the risks, if any, from these differences in deposit insurance regimes? I particularly ask, and maybe this is a mistaken worry, but I particularly ask in a world where presumably businesses could shift their current accounts very rapidly, as we've seen.
Yeah, it's an important question. I don't think there's the U.S., I think it's fair to say, is generally recognized as having a very strong deposit insurance system. The FDIC is actually celebrating its 90th anniversary this year. I believe was the first national system of deposit insurance established. So we have a long history and are viewed as a strong system. And I don't know that we viewed deposit insurance per se as a cross-border risk for us. But I think strong deposit insurance regimes or systems in other jurisdictions have real financial stability value in those jurisdictions, which ultimately can have consequence for the United States. And we've been actively engaged internationally on this. The FDIC, as chair of the International Association of Deposit Insurers, which developed the first international standards for deposit insurance. Yep. And we've worked closely with other jurisdictions in the world and worked very closely, in particular with the Europeans, on both resolution and deposit insurance. So it's something that we're very strongly supportive of.
I'll turn to our audience, our live audience, for on-the-record questions in a moment. Just a last question and a half from me, if I could, please. One, in your opening remarks or your speech, which is more important, you specifically referred to a desire to implement Basel III in such a way, if I understood you correctly, that would include banks at the 100 billion or above size level, which I'm very excited to hear you call for. Could you say a little bit about how Basel III and implementing that rule to that size level would interact with pressures for consolidation in the banking system? I mean, the Biden administration has recently indicated some willingness to reconsider their opposition to banking sector consolidation. There are trade-offs, but there is a literature suggesting that in a lot of high-income economies, you tend to have an hourglass-shaped or a very concentrated banking system. How does Basel III implementation affect that situation in your view?
Well, I think in the first instance, we're thinking about capital requirements from the standpoint of the risks of the institution and the resilience of those institutions. And I don't think we're considering it in the context of how it might affect consolidation one way or another. I think we have a strong interest in a diverse banking system. I think the banking system in the United States with community banks, regional banks, and the money center global banks is actually a strength of the United States, which distinguishes it from other jurisdictions. And I think we want to preserve that. On, bank mergers, I think you need to distinguish a bit from considering the issue in a stress environment where we may have institutions at risk of failure, where mergers may take place in response to genuine financial stability risks posed by a failing institution. And you really want to distinguish that from the broader set of considerations about how bank mergers are considered by the banking agencies, as well as the Justice Department under the Bank Merger Act. And as you may know, there's a review underway by the banking agencies in conjunction with the Justice Department of how we consider bank merger applications under the statutory factors of the Bank Merger Act. And I think that, that process is going to continue, separate and apart from, I think, this recent episode.
Thank you. Just a final follow-up question for those in the audience globally like me who are not as expert as you and your colleagues. Why does it take 7 or 8 or however many years to implement this? I understand the year for public comment, but values fluctuate hugely in capital and in bank lending. Interest rates fluctuate hugely. Banks are expected to adapt to this in real time. So why does this regulatory change need to stretch out for so many years?
These are significant changes to capital requirements. As I indicated in my remarks, they are pretty complicated. And we want to give, these are large, complicated institutions. So we want to give them an appropriate period to incorporate them into their systems and to implement them on a gradual basis. And this is something we are also trying to coordinate internationally so that the institutions can do it in an orderly way and does not have a disruptive impact on the institutions or the market.
Okay. So if someone wants to go to the standing mic, please identify your name and affiliation when asking a question.
Hi, Dennis Kelleher, Better Markets. Thanks, Adam, for doing this. And Mr. Chairman, thanks for your remarks. What always comes up, as Adam points out, is that the banks scream, well, you're not hurting us. You're going to cause us to reduce lending, which is going to hurt the economy. It's interesting, they never mention what really gets hurt is executive compensation, which is often driven by and amplified by leverage and lower capital. But leave that aside. One thing nobody talks about is the impact of not having capital. So if you had, I don't call it 20% capital before '08, and it prevented the '08 crash, and it avoided the catastrophic consequences, would we have been hurt by that capital increase before '08 versus what the devastating Great Recession afterwards? And more recently on Silicon Valley Bank, no less an authority than Goldman Sachs said that there was going to be a GDP contraction or cost of about 0.6% of 0.6 of 1% as a result of a credit pullback because of the collapse of Silicon Valley Bank. And others have estimated up to 1%. So the cost of not having capital
Dennis,
seems to me to be never.
Pretend to put this as a question.
So I'd like to know, why do the regulators actually quantify the cost to Main Street and the economy of not having enough capital?
Thank you. Good question.
It's an important question, and it's a fair point to make. And, you're sort of trying to speculate on what would have been. But what we do know is the cost. There have been estimates on the cost of the 2008 financial crisis, which was profound for the U.S. and global economy. If we could have even mitigated it, much less avoided it, the benefits in terms of economic growth, jobs, the well-being of people would have been dramatically impacted. And that's why you want to be thoughtful and forward-looking in establishing these standards, and particularly focused on the institutions that can have, the biggest impact on the stability of the system. And trying to do it in a thoughtful way, in a forward-looking way, and in a way that the institutions in this system can absorb is really what we're trying to do here. It's why I underscored at the beginning, it's an important initiative that we need to follow through on.
Thank you. Anyone else? A question, please.
Hi, I'm Laura Tyson. I'm a professor at the University of California Haas School of Business. They're really follow-ups to the conversation we've been having. One is on the issue of concentration. So you mentioned that the resilience or the strength of the U.S. banking system is community, regional, and large. But do you think, or is there evidence from all of this, that there could be an argument for more consolidation within the regional banking system itself, that maybe some of these players are too small relative to their ability to support the kind of capital requirements and other requirements you think they need to have? So that's the first question, is a little bit. The second question is really related to the last conversation and to trying to think about making the case clearly that actually raising these capital requirements over time will actually increase the capability of the system to lend. So that essentially is an argument underlying all this. People will say, if you raise these capital requirements, it's going to undermine the ability of these banks to lend and support the economy. The evidence you suggested is actually, it's the opposite. And I think it's probably really important to make that case as much as possible, Just a quick question. You mentioned the $10 trillion the federal government spent on the pandemic. Is that overall everything the federal government did, not just on the banking system and on the entire, that number?
Yeah, that was one estimate from a respected source, and we footnoted in the speech, and you can look at it.
Okay, all right, fine.
The range of estimates that's the responsible lower bound. The range of estimates goes up to 14 trillion.
Okay, all right, okay.
The range of usual estimates.
I guess one thing, this is more processy. So how does our system, and let's not worry about the other systems, how do we move forward with this? We have a comment period, and then what happens? Does it go through does Congress have to act? Is it just goes through the system of regulators we currently have?
So let me so you got three right there, right? So first, no, it's a regulatory authority vested in the U.S. federal banking agencies, the Federal Reserve, the FDIC, the OCC. Our process, by the way, under the Administrative Procedures Act, is to issue rulemakings, proposed rulemakings, seek public comment on a major rule like this, which is pretty complicated. We're going to give an extensive comment period. I suspect we're going to receive a lot of comments on the proposal. The agencies, again, consistent with the APA, are very diligent in reviewing all of the comments and take them into consideration in developing the final rule that will be implemented, so that the next stage of the process, after the proposal is released and we receive the comments, the agencies have the authority to finalize the rule. And then the rule, and establish an effective date, and then also establish a transition or implementation period for the institutions to actually implement the rule. So that's the third question. I'll take them in reverse order if I can. On the second one, that's why I'm giving this speech, because I think it's an important point to make. That stronger capital supports lending and supports the economy and avoids the destabilizing effect that can come from stressed large institutions, particularly if they fail. So stronger capital is really consistent with economic growth and credit availability and financial stability. And then third, on the consolidation issue, one, the banking agencies with the Justice Department have authority to review bank mergers. We have 4 statutory factors that we're required to consider. One is competition, one is prudential risk, third is serving the convenience and needs of communities, and a fourth factor added under the Dodd-Frank Act is financial stability. So that's and the agencies, and this is a matter of public record, the banking agencies together with the Justice Department are undertaking a review of how the agencies apply those factors and consider merger applications under the law. So that's, in process. The consolidation issue, one, I think you need to look at merger applications on a case-by-case basis, frankly, at the particulars of the 2 institutions for which a merger is being proposed. There's an argument made that you suggested that if institutions were larger, they might be better able to compete with the biggest banks. There's also a case that more concentration can result in institutions that have present greater financial stability risk. So there are countervailing things to consider and balance there.
Thank you. With apologies, that's the end of our official time. Thank you all for joining us today online and in person for an important speech and discussion on the need for greater capital via the Basel III framework implementation by Martin J. Gruenberg, Chairman of the Federal Deposit Insurance Corporation Board of Directors. Thank you for joining us today.
No, thank you, Adam. Thank you. Thank you, Adam.
Great. Thanks so much.
No, thank you.
Oops.